The retail trading industry is built on a very specific, very expensive myth. It is the idea that success requires a perfectly accurate model, a system that reads the market and executes winning trades 90% of the time. This deterministic mindset traps the retail investor. It forces them to view every single interaction with the market as a binary pass or fail test of their own intelligence. This stands in direct contrast to the empirical reality of professional asset management and systematic trend following. If you audit the ledgers of consistently profitable institutional traders, you will find that their win rates often hover between 30 and 40%. Most of their trades are technically failures. This presents a mathematical paradox. How do professional systems generate compounding, long-term profits while failing on the vast majority of their executions? The answer begins with abandoning the crystal ball. The pursuit of a perfectly predictive system is a mathematical dead end. It is a guarantee of retail failure. To understand professional price action, look at the market at a microscopic tick-by-tick level. It is not a smooth, logical narrative. It is highly irregular, completely random movement. Financial academics model this using the random walk hypothesis, or Brownian motion. The core premise is that a current price has no inherent memory. The exact direction of the next tick is statistically independent of the last. This inherent randomness destroys any technical strategy that requires exact short-term predictions of an asset's next movement. Professional traders define their work as the rigorous management of probability distributions, distancing themselves from the retail obsession with prediction. Because the market operates on a random walk, the outcome of any single isolated trade is essentially random noise. Whether your next specific trade wins or loses is irrelevant. To survive the markets, a trader must abandon the psychological need to be right and instead focus entirely on exploiting a mathematical edge over a long series of events. That statistical edge is measured by a single metric, expected value, or expectancy. This is the ultimate filter that determines whether a trading strategy is valid or mathematically doomed. This equation shows why a high win rate is useless if the magnitude of your losses outstrips your gains. It works by integrating two opposing forces, the frequency of your wins and the strict magnitude of your average gains versus your average losses. Let's run a theoretical proof. Assume you operate a system that wins only 40% of the time. You will take 6 losses out of every 10 trades. But you apply a strict risk architecture to this system. You risk exactly $1 of initial capital to hit a target reward of $3. When you execute the math, 40% times $3 minus 60% times $1, you are left with a positive sum. Despite losing the majority of their trades, this trader generates a positive expected return of 0.6 units of risk every single time they enter the market. A profitable system does not avoid losses. It simply engineers the payoff ratio to mathematically absorb and overwhelm them. If the math behind a 40% win rate system is this clear, why do the majority of retail traders fail to execute it? The failure is psychological. Behavioral finance defines this as the neglect of probability, the human brain's inability to process statistical variance, demanding immediate, predictable results instead. The statistical reality of a 40% win rate is a trader is guaranteed to encounter strings of 4, 5, or even 6 consecutive losses. This triggers prospect airy. Humans feel the psychological pain of a financial loss much more intensely than the pleasure of an equivalent gain. This creates a fatal behavioral drift. During a normal mathematical drawdown, the retail trader feels the pain, panics, and assumes the system is broken. Mechanically, this panic destroys the expectancy formula. The trader widens their stop loss to avoid taking a hit, or cuts a winning trade early just to secure a small victory, instantly breaking their required risk-to-reward ratio. The only real empirical countermeasure to emotional bias is rigorous data logging. Expected value is a fantasy until it is proven across a specific asset using a concrete historical dataset. Look at this chart plotting algorithmic entry markers. To calculate real expectancy, you must document exact entry and exit prices, the specific time frame, the setup conditions, and your risk per trade, or R multiples, at these exact points of execution. A journal acts as an objective mirror. It reveals whether you are actually executing your mathematical edge or succumbing to impulsive, heuristic-driven biases. To verify if an edge actually exists, you must obey the sample size rule. A trader has to execute and log a minimum of 30 to 50 trades of the exact same setup. Without a meticulous ledger tracking the math of your wins and losses, you are not operating a trading business. You are simply gambling. To trade properly, pull your analytical lens away from the noise of a single session and look at the macro reality of a large dataset. This distribution curve represents trades at scale. Over 100 or 1,000 executions, the chaotic variance of individual wins and losses smooths out. Here, the underlying expectancy overrides the market's random walk. The high reward ratio drags the overall outcome into profitable territory. Professional traders strictly rely on this macro math. They know that a single loss is just a tiny expected business expense required to fund the larger probability curve. Time and trade volume act as the mechanisms that allow a statistical edge to surface over short-term market noise. The entire expectancy equation relies on an absolute, non-negotiable rule. Your losses must be capped ruthlessly to protect the mathematical integrity of the system. Professional trading success is dictated entirely by strict risk-to-reward architecture, not market predictions. You have to reject the marketing illusion of the Holy Grail and fully accept the mathematics of losing. Stop trying to predict the outcome of your next trade. Instead, focus entirely on flawlessly executing a documented statistical edge over your next 100 trades.